Do you ever feel like you're just surrounded by a word? Every time you turn on the TV, radio, or speak to someone, the same topic comes up again and again. A song, a phrase, whatever, you just can't escape it. I'll give you an example. Thanks to a recent Netflix show, a song that was made before I was even born is once again topping the charts globally, and you cannot escape it. Well, it's not just Kate that's been following us around this year. There is another word that's following us around in 2022, and this one is far more scary.
Inflation.
Inflation. Inflation.
More inflation. Inflation.
Inflation.
Inflation.
Inflation. Inflation.
Inflation.
2022 feels like we are running up that hill, begging for someone to swap our places. Because the invisible force that is inflation is tearing us asunder, making our portfolios do stranger things. If you've clicked this video, you're probably wondering how inflation will affect your investments. You're probably now also wondering why a grown man is quoting Kate Bush lyrics to you. Well, I will answer both of those questions for you today. But before that, for anyone that doesn't know, hello everyone, my name is Tom Morgan from the YouTube channel That Finance Show. I'm a fully qualified financial planner and advisor based here in the UK, and I'm today coming to you in collaboration with the good people from Trading 212, who just want to help you make smarter decisions when it comes to investing. Remember, nothing in this video should be construed as financial advice. In preparation for this video, I was looking for a quote about inflation. Something to set the stage and provide a little context before we get into the nitty-gritty of the video. Well, let me tell you. Google inflation quotes and you will be met with what can only be described as negative sentiment. If inflation continues to soar, you're going to have to work like a dog just to live like one. Or how about this from Ronald Reagan? Inflation is as violent as a mugger, as frightening as an armed robber, and as deadly as a hitman. There is something not right here. John Maynard Keynes, a legendary economist, said that some inflation is a good thing, helping to prevent the paradox of thrift, he said. Basically, it stimulates the economy by encouraging people to spend money. Essentially, you're more likely to spend money today if you know that things are going to be more expensive in the future. This incentive to spend increases the demand for products and services and fundamentally keeps the financial wheels spinning. If this is true, why is there such a disdain for inflation everywhere you look? A violent mugger is hardly a nice way of describing a healthy economy, is it? In 1977, David R. Morgan published a piece of work called Overtaxation by Inflation. Weirdly, my dad is called David Morgan. The only thing he ever published was me. And my sisters. The 70s had rampant inflation, much like today, and David argued that by failing to amend the tax bands, the government had essentially shifted an extra tax burden onto the general public. Inflation is the one form of taxation that can be imposed without legislation. You see, one of the main causes of inflation is central banks printing cash. This increase in the monetary supply reduces the value of the cash that we already have. The government benefits from this in two ways. It lowers the real value of its debt pile and it increases the nominal value of its revenues. Now remember the terms nominal and real. They're important and we'll come back to them later. Essentially, the government can make their debts worth less and their income look better on paper with inflation. But it is a disaster for households which see the value of their cash, their wages all shrink as the currency they work so hard for just becomes worth less and less. This is why there are so many negative quotes about inflation. Inflation is the devaluing of money, and such it affects anyone who earns and spends cash. So if we don't find a way to outrun inflation, for our earnings to increase over and above the rate of inflation, we get poorer. It's like we are running up a hill. Here comes Kate Bush again. It's the steepness of that hill that is the rate of inflation, and the higher the rate of inflation, the harder it is to get up that thing. It's this idea of outrunning inflation that we need to keep close in our mind when we talk about how it will affect our investments. Remember before we spoke about nominal and real rates of return? Well, there is a widely accepted logic that the stock market tends to return between 9 and 12% a year on average over the long term. Now, I'm getting those figures from 120 years worth of data presented by Credit Suisse. Please note, returns can vary wildly year on year. But the point here is that 9 to 12% is the nominal return. It's before costs such as taxes, fees and inflation. Now, with trading 2-on-2, your fees are some of the lowest in the game, just saying. But the worry here is inflation. If inflation is at 9% and your nominal rate of return is 9%, then your real rate of return, the amount that you're actually richer as a result from investing in the first place, is actually nothing. You haven't moved up that hill at all. You're right where you started. Real returns are what investors should care about, and inflation is a disaster for real returns. It eats away at the value of that return by destroying the cash you're making in real time. So does this mean that we shouldn't invest? No, it doesn't. Everyone, apart from central banks, hates inflation because it affects us all. The only choice that we have is to attempt to outrun it. And what that then comes down to is where is the best place to park our cash in times of high inflation? On screen is a graph that demonstrates the performance of stocks, savings and cash over the course of 20 years at a time, when cash in the bank actually earned a return. Even with this in mind, we can see that equities, another name for stocks, wipe the floor with the others, and it is the only asset that, when adjusted for inflation, gained in value over the time period. In fact, in the 35 major markets across the world, over a period of 100 years, stocks has beaten inflation. Every country, every time, stocks have managed to drag themselves up that goddamn hill. Why? Well, businesses, which is what you are buying when you buy stocks, have the ability to increase their prices. In fact, inflation is either caused by the printing of money or the increase in prices from businesses. This ability to raise prices gives businesses the unique opportunity to continue to make profit even through times of high inflation. Cash is literally losing value, and bonds, which are IOUs or loans, have a fixed rate of return attached to them, so the return you're going to get is already predetermined. We can see examples of price rises right now. I know we all know about our energy bills and the rapidly rising profits of the energy companies whilst we literally burn fivers just to stay warm. But then you have businesses like Tesla, who have upped the prices multiple times on their cars to deal with increased costs and sky-high demand. Or maybe it's to pay for an upcoming legal battle with Twitter, who knows. That's got to go down as one of the biggest cases of buyer's remorse ever. I thought these expensive running shoes that I bought that I never wear were a waste of money. There's a joke in there somewhere, isn't there, about I'm telling you to run up a hill and I've barely even taken the label off these bad boys. Hey, I could always burn them. Cheaper than putting the central heating on. But to be balanced, not all businesses can magically sidestep inflation through increased prices. One example of a business that's really struggling with inflation right now is Kraft Heinz, the makers of Heinz ketchup. To many, ketchup is as essential as petrol in their lives, but this sugary sauce has been disappearing from supermarket shelves. Why? Heinz are arguing with Tesco's around proposed price increases, as they say they need to up the price of their tomato sugar syrup. Tesco won't have it, and there is a stalemate leading to Tesco's shelves being empty of Heinz products. A direct example of how inflation, and perhaps more importantly the inability of a company to be able to pass on the costs of inflation, has really affected their business. This will affect Heinz's sales and therefore their profitability, so if you're an investor in Heinz, you may see this reflected in their share price. But in the main, stocks and the businesses that they represent tend to outrun inflation because of their ability to increase prices and find other ways to profit. But I can already feel some of you sitting there thinking, well, if stocks are such a great bet in times of inflation, then why is my portfolio down 80%, Tom? Well, currently, it isn't really inflation that's hammering stocks. It's the central banks of the world's reaction to it that is. When people ask, how will inflation affect my investments? What they should really be pondering is how will rising interest rates designed to slow inflation affect my investments? The summary is, it isn't good. You know the idiom that the cure is often worse than the disease? Well, if inflation is the disease, then interest rates is the cut the foot off to save the leg kind of cure. First of all, as interest rates rise, debts like mortgages and credit cards become more expensive, meaning people have less money to spend. People spending less money means businesses make less profits. Businesses making less profits means share prices fall. Secondly, rising interest rates makes fixed income investments potentially more attractive to some investors. Those bonds and cash that didn't really perform versus stocks start to get higher interest rates attached to them. And this is attractive. Seeing a bond go from 1% to say 4% return will tempt people towards that more predictable return. But remember, we're running up a hill, and a 4% return against 9% inflation still doesn't cut it. You're still down 5% in real terms. It isn't just the impact on individual consumers by rising interest rates that causes stock markets to fall. The very same can be said for businesses themselves. Like individuals, debt becomes more expensive, making it harder for businesses to borrow and reducing their ability to grow and service the debt that they already have. So as interest rates have risen to combat the spiralling inflation, many investors have panicked and pulled funds out of the market in fear that central banks will continue to raise interest rates, essentially crushing the market in the process. Look, I like to normally have a laugh with these videos, but sometimes it does call for a slightly more serious tone. Inflation is seriously squeezing people's costs of living, and central banks have to act to stop it. The tool they have at their disposal to do this are interest rates, and we have had rock bottom interest rates globally for over a decade now. That has fueled the colossal rise in the prices of stocks and other assets, and we now enter a new period with a change in the narrative. As interest rates rise, we as investors will be participating in market conditions not seen since the turn of the millennium. And that means there is uncertainty around how stocks will perform. And if there is one thing that markets hate, it's uncertainty. We are likely in for a bumpy ride as the world gets used to the new, higher interest rules of the game. But whilst many investors won't have experienced this for a few decades, world markets have been through periods like this before. 2008, most of the 70s, the 50s, all periods of high inflation and still great times to invest money over the long term when looking back with hindsight. We all need to do something with our cash to make sure that it is working for us. And although past performance is no guide to future results, 100 years prior to this date, the stock market has outpaced the returns of other assets. Inflation is the term of the moment on the media's lips, and it is being forced upon us at every turn, and in truth, because it gets views. You did click on this video after all. The panic of seeing your investments drop short term is something many investors are feeling right now. And as interest rates rise and the cost of living crisis gets worse, our emotions is something we all need to contend with. But remember, these are short-term headlines on our long-term investing journey. Try to remind yourself when things are grim that markets tend to look forward. This is why it's so hard to time the markets. They're always trying to guess what will happen 5 steps ahead. We don't know what markets will do day to day, and we shouldn't be amending our investment strategy as a reaction to these short-term factors. It's like the Kate Bush song that has permeated this entire video. No one could have imagined that would have come back bigger and better than ever. Just a random feature in a Netflix show and it propels it back into the mainstream and it's more popular than it ever was. And the markets can be similar in that way. When they look to be done, when you think everything is over, there can be a change in the narrative and things can change in an instant. The most important thing we can do as investors is just keep running up that hill. And now the moment you've been waiting for since you clicked on this video. Take it away, Kate. No, sorry, copyright issues. If I did that, I'd have to write a big fat check to Kate, and quite frankly, she has earned more than enough money recently. Me and the team at Trading 212 love putting these videos together for you. I hope you got value from that. Please, if you did, give the video a like and consider subscribing to the Trading 212 YouTube channel with notifications turned on so you do not miss any future uploads. If you're feeling really kind, could you head on over to the App Store or Google Play where you can leave up to a 5-star review for the Trading 212 app just to let others know how good you think it is. My name's Tom Morgan from That Finance Show. Until next time, thanks for watching and I'll see you real soon.